Stop what you're doing right now, this second. Tell your dog you will walk him later. I do not care if you're in the shower. Get out and grab a towel. This is more important than whatever you think you're doing right now. Exit out of the dating app where you are swiping right on people. She will never match you back. Are we clear? Good. Oh, and one more thing. If you own silver, physical silver, ETF shares, futures contracts, anything, do not look at your brokerage account until after you finish this video, because if you look right now, you are either going to panic or you're going to celebrate, and I need you to do neither until you understand what actually happened while you were sleeping. Ladies and gentlemen, Asian guy here, it is January 14th, 2026, and I'm about to tell you something that is going to make you sick to your stomach if you got stopped out overnight, but it's also going to teach you the most valuable lesson about how this rigged market actually works. While you were sleeping last night during the Asian trading session, something catastrophic happened, something that I warned about, something that the banks engineered specifically to steal your positions. China and Japan, the institutional players who control Asian market flow, liquidated silver from $93 per ounce all the way down to $83 per ounce in a matter of hours. $93 to $83, that's a $10 drop. A 10.7% crash in the middle of the night while Western retail traders were asleep, thousands of stop losses triggered, thousands of retail positions liquidated, thousands of individual investors forced out of their winning trades at the worst possible price. And now, this morning, silver is back at $91 heading toward $100 like nothing ever happened. You got played. We all got played. And I'm going to explain exactly how they did it, why they did it, and most importantly, how to make sure it never happens to you again. Because this happens for one reason and one reason only. Greed. The greed of placing stop losses too tight. The greed of trying to day trade a market that is controlled by institutions who can move price wherever they want, whenever they want. Let me be very clear about something before we go any further. I am here to protect you. I am here to warn you. My mission is not to pump silver prices or to sell you courses or to make money from your losses. My mission is to help you understand how this game is played so that you don't become the exit liquidity for banks and hedge funds who are desperately trying to steal your positions and shake you out of the market. So pay very close attention to what I'm about to explain. Because understanding this difference, understanding why 99% of day traders fail while swing traders with wider stops have much higher success rates, this understanding could save you tens of thousands of dollars, maybe hundreds of thousands, maybe your entire trading account. Let me start with exactly what happened overnight, because the numbers don't lie and the chart doesn't lie. Around 11 p.m. Eastern Time on January 13th, which is morning trading hours in Asia, silver was trading at approximately $93 per ounce. Shanghai had closed the previous session at $93.31. The momentum was strong. The rally looked unstoppable. Everything suggested we were heading toward $100 within days. And then, starting around midnight Eastern Time, the sell orders started hitting. Massive sell orders. Not retail size, not individual trader size, institutional size. Hundreds of contracts at once. Thousands of ounces dumped onto the market in coordinated waves. The price started dropping. $93 became $92, then $91, then $90. And here's where the nightmare began for retail traders. As the price dropped through $90, stop-loss orders started triggering. Every retail trader who had bought silver at $85 or $87 or $89 and placed their stop-loss at $90 just to be safe, those stops got hit. Their positions got liquidated automatically. They got forced out of winning trades. But the selling didn't stop at $90, it accelerated, because now the institutions could see where all the stop losses were clustered. They could see the order book. They could see that there was a massive wall of stops at $88, so they pushed harder. More selling, more pressure, more forced liquidations. $90 became $89, then $88, then $87. At each level, more stops triggered, more retail traders got knocked out, more positions got handed over to the institutions at bargain prices. The cascade was mechanical, the algorithm was perfect, the execution was surgical. And then they hit the $85 level. This is where the really tight stops were placed. The day traders, the people trying to catch quick moves with tight risk management, the people who thought they were being smart by cutting losses quickly. Every single one of them got stopped out between $85 and $83. The low of the move was $83.12. Let me say that again, $83.12. A full $10 below where Asian trading started just hours earlier. And then as quickly as it started, the selling stopped. The institution stepped away, and the price, it immediately started recovering. $83 became $85, then $87, then $89, then back to $91 where we are now. The entire move down and back up happened in roughly 6 hours, a flash crash designed specifically to trigger stop losses, a coordinated attack designed specifically to steal your positions, and it worked perfectly. Thousands of retail traders woke up this morning to find their silver positions closed at $85 or $86 or $87. They took losses on trades that would have been profitable if they had just held through the night. And now those same traders are watching silver climb back toward $100 while they're sitting in cash, angry, frustrated, convinced the market is rigged. And you know what? They're right. It is rigged, but not in the way they think. Let me explain what actually happened and why it happened, because this is the lesson. This is what you need to understand. The institutions, the banks, the hedge funds, the big players who move billions of dollars, they don't have stop losses. Let me say that again because it's critical. Banks do not use stop losses. When JP Morgan or HSBC or Goldman Sachs holds a position, they don't place an automatic order that liquidates them if the price moves against them. Why not? Because they have unlimited capital. They have access to Federal Reserve liquidity. They have credit lines that allow them to hold losing positions indefinitely. They can wait. They can be patient. They can ride out volatility that would destroy retail traders. But you and I, we're retail. We don't have unlimited capital. We don't have access to Fed liquidity. We can't hold positions forever. We need stop losses to protect ourselves from catastrophic losses. We need risk management. That's just reality. That's how retail trading works. But here's the trap. Here's where greed comes in. Here's where most retail traders destroy themselves. They place stops that are too tight. They try to day trade markets that are controlled by institutions. They convince themselves that they can capture quick moves with tight risk and come out ahead. And the statistics prove they're wrong. Listen to this carefully. 99% of day traders are not profitable. 99%. That means if you're day trading silver or gold or any commodity with tight stops trying to catch quick moves, you have a 1% chance of long-term success. Those are lottery ticket odds. Those are casino odds. You're gambling, not investing. Now compare that to swing traders. Swing traders who hold positions for days or weeks instead of hours. Swing traders who use wider stops that account for normal market volatility. Swing traders who understand that price doesn't move in straight lines. Their success rate is dramatically higher. Not 99% failure, more like 60-70% failure. Still not great odds, but infinitely better than day trading. Why? Because swing traders with wide stops don't get shaken out by engineered volatility. When the institutions run a stop hunt, like they did last night, swing traders with stops at $75 or $70 don't get touched. They ride through the manipulation. They're still in their positions this morning. They're still profitable. They didn't give their shares to the banks at $85. This is the fundamental lesson that most retail traders never learn. Tight stops feel safe. They feel like good risk management. They feel like you're being disciplined and professional. But in reality, tight stops in manipulated markets are suicide. They guarantee that you'll get stopped out at the worst possible prices right before the move you were waiting for actually happens. Let me show you the mathematics of why this matters. Let's say you bought silver at $87 with a position size of 100 ounces. That's $8,700 invested. Now you have two choices for where to place your stop. Choice A, tight stop at 85s, that's a $2 risk per ounce or $200 total risk on the position. Feels safe, right? Small loss if you're wrong, but what happened last night? You got stopped out at $85. You took a $200 loss, and now silver is back at $91. You missed a $4 gain per ounce, which would have been $400 profit. Choice B, wide stop at $75. That's a $12 risk per ounce or $200 total risk on the position. Feels scary, right? Much larger potential loss. But what happened last night? You didn't get stopped out. The low was 83, nowhere near your $75 stop. You're still in the position. And now with silver at $91, you're up $4 per ounce, which is $400 profit. Same trade, same entry price, but choice A lost money and is now out of the position. Choice B made money and is still in the positioned for further gains. The only difference? The width of the stop. Now, I know what you're thinking, but Asian guy, if I use a $12 stop instead of a $2 stop, I need to use much smaller position size to maintain the same dollar risk. Exactly. That's the point. That's proper risk management. If you're risking $200 on a trade, you don't need to risk $2 per ounce on 100 ounces. You should risk $12 per ounce on 17 ounces. Same $200 total risk. But now your stop is wide enough that normal volatility and institutional stop hunts don't take you out. You're positioned to survive the manipulation and capture the real move. This is what professional traders understand that retail traders don't. Position size and stop width must be adjusted together based on volatility and market structure. In a volatile, manipulated market like silver, you need wide stops, period. And if that means smaller position size to maintain your risk tolerance, then so be it. Better to be in the trade with a small position than out of the trade entirely, because you got stopped out with a position that was too large and a stop that was too tight. Now let me show you what's actually happening in the silver market right now, because last night's crash wasn't random. It wasn't natural selling pressure. It was engineered, and I can prove it. Look at what happened to the Shanghai-New York spread. Yesterday, before the crash, Shanghai was trading at an $8 to $10 premium to COMEX. That spread represents physical shortage. It represents the fact that buyers in Asia are willing to pay more for real metal than the paper price in New York. During last night's crash, did the Shanghai premium disappear? Did Chinese buyers suddenly decide they didn't want silver anymore? No. The premium stayed. In fact, it widened. At one point during the crash, COMEX was at $83 and Shanghai was still bidding $93.95s. The spread blew out to 10 to 12s. What does that tell you? It tells you the selling was happening exclusively in the paper market. It tells you there was no real physical selling. It tells you this was institutions dumping paper contracts to trigger stops and accumulate positions. Pure manipulation, pure stop hunting, pure theft from retail traders who had their stops placed in obvious locations. And here's how we know it was coordinated. Look at the volume. During normal Asian trading hours, silver futures volume is relatively light, maybe 10,000, 15,000 contracts per hour. But during last night's crash, volume spiked to over 50,000 contracts in a single hour. That's not retail panic selling. That's institutional dumping. That's coordinated. That's planned. And look at the recovery. As soon as the price hit $83 and all the stops were triggered, the selling stopped immediately. Not gradually, immediately, like someone flipped a switch. And then buyers stepped in and pushed the price back up just as quickly. Within 3 hours, we were back at $80. By morning, back at $91. If this was real selling pressure, if this was genuine bearish sentiment, the price would have stayed down. Sellers would have kept selling. The recovery wouldn't have been instant, but it was instant. Because the selling was never real. It was a manufactured event designed to steal your positions. Now let me tell you why this is happening more frequently, why stop hunts are becoming more aggressive, why the institutions are more desperate than ever to shake retail traders out of silver positions. It's because the banks are trapped. They're short silver at $30, $40, $50, $60, and now silver is at $91, heading toward $100. Their losses are mounting every day. Their risk managers are screaming. Their capital requirements under Basel III are crushing them. So what do? They can't cover their shorts in size because there's not enough physical metal available. The vaults are empty. Shanghai is paying premium prices and still can't get enough supply. If the banks try to cover by buying, they'll push the price even higher and accelerate their losses. Their only option is to try to scare retail traders into selling. Run the stops. Create panic. Engineer flash crashes. Make people think the rally is over. Make people think they need to get out before it gets worse. And then buy the positions that retail just sold at discounted prices. This is the game. This is how it works. The banks can't win in a fair market. The fundamentals are too strong. The shortage is too real. So they have to win through manipulation, through stop hunts, through psychological warfare against retail traders who don't understand what's happening. And the sad part? It works. Most retail traders fall for it every time. They see a $10 drop and panic. They see their stop get hit and feel relieved they protected their capital. They watch the price recover and feel stupid for selling. Then they buy back in at higher prices. Then they get stopped out again on the next engineered crash. Over and over, the cycle repeats. The banks win, retail loses. But you don't have to be part of that cycle. You can break it. How? By understanding the game. By using proper position sizing with wide stops. By thinking like a swing trader instead of a day trader, by recognizing that in a manipulated market controlled by institutions with infinite capital, tight stops are suicide. Let me give you the specific rules I use. These are not universal truths. These are not financial advice. These are the guidelines that have kept me profitable in silver for years while watching countless other traders blow up their accounts. Rule 1. Never place stops within 15% of current price in silver. If silver is at $90, your stop should be no tighter than $76.50. That's $13.50 of room. Feels scary, right? But that's what's required to survive the volatility and manipulation in this market. If that risk is too large for your account, reduce position size. Don't tighten the stop. Rule 2. Place stops below major technical support levels, not at round numbers. Everyone put stops at $90 or $85 or $80. Those are the levels the institutions target. Instead, look at where the last major swing low was. Place your stop below that level. Make the institutions work harder to get your shares. Rule 3. Expect at least one major shakeout attempt per week. This isn't normal markets. This is silver. This is manipulated. The banks will try to run stops regularly. If you're not mentally prepared for sudden 10% drops that recover within hours, you shouldn't be trading silver. This is part of the game. Rule 4. Position size for the worst case scenario, not the best case. If your stop is at $75 and silver is at $90, your risk is $15 per ounce. If losing $15 per ounce would devastate your account, your position is too large. Size down until you can handle that loss without emotional damage. Rule 5. Never day trade silver unless you have inside information or can handle losing 99% of the time. The statistics are clear. Day trading doesn't work for retail and manipulated markets. Swing trading with wide stops works much better. Choose your battles wisely. Now let me address the people who got stopped out last night, the people who are angry right now, the people who feel cheated. You're right to be angry. You did get cheated. But being angry doesn't help. Learning from it helps. Ask yourself, why did I place my stop where I placed it? Was it based on technical analysis and market structure, or was it based on how much loss I was comfortable with emotionally? If it's the latter, you're doing it backwards. The market doesn't care about your comfort level. The market is going to do what it's going to do. Your stops need to be placed based on what the market is likely to do, not based on what you hope it won't do. Ask yourself, was I trying to day trade a market that requires swing trading? Was I trying to catch quick moves with tight risk in a market where institutions can move price $10 in either direction anytime they want? If so, you were playing a game you can't win. The institutions have more capital, better information, and the ability to manipulate price. You can't beat them at day trading, but you can beat them at swing trading with proper positioning. Ask yourself, did I learn anything from this, or am I going to make the same mistake next time? Because there will be a next time. The banks will run stops again. They're desperate, they're trapped, they need your shares, and they're going to keep trying to scare you out of them. The question is, will you fall for it again, or will you be prepared? Now let me tell you what's coming next. Because understanding the past is useless unless it helps you prepare for the future. Here's what I see based on patterns, based on market structure, based on how these manipulated markets work. Short term, next few days, we're going to see continued volatility. The banks are going to try again, maybe not tonight, but soon. Another stop hunt, another flash crash, maybe down to $85, maybe down to $80 if they're really aggressive, but the physical market won't follow. Shanghai will stay elevated, India will stay at premium prices, the fundamentals won't change. Medium term, next few weeks. One of two things happens. Either the paper price finally breaks free and gaps up to meet the physical price, Shanghai premium forces COMEX higher, or we get a delivery failure that exposes the whole fraud, COMEX declares force majeure, and the paper market dies. Either outcome is massively bullish for anyone holding physical or positioned with wide stops who can survive the manipulation. Long term, next few months. Silver is going to 150, 200 plus as the supply shortage becomes undeniable and industrial users panic about securing metal. The bank's short positions will eventually have to be covered or defaulted on. The system will break, and everyone who survived the shakeouts with proper risk management will be rewarded massively. But you have to survive to get there. You have to be positioned correctly. You have to use wide stops or hold physical. You can't day trade your way through this. You can't use tight stops and hope to make it. The institutions will take you out every time. So here's my final message to everyone watching this. The $93 to $83 crash last night was not an accident. It was not natural selling. It was engineered to steal your positions. Thousands of retail traders got stopped out. Thousands of people woke up this morning angry and confused and positioned wrong. Don't be one of them next time. Learn from their mistake. Use wider stops. Think like a swing trader. Reduce position size if you have to, but give yourself room to survive the manipulation. Because the manipulation is real. The stop hunts are real, and they're going to continue until the system breaks. The banks are desperate. There are thousands of institutions out there who want your silver positions. They want to shake you out. They want you to panic. They want to buy what you're selling at discount prices. My mission, my purpose for making these videos is to protect you from that, to warn you, to help you understand the game so you don't become the victim. This is not financial advice. I'm not telling you what to do with your money, but I am telling you what I see. And what I see is a market where retail traders are being systematically robbed by institutions who know exactly where the stops are and exactly how to trigger them. If you got stopped out last night, learn from it. If you're still in your positions, protect them with proper stops. If you're thinking about entering, do it with swing trading mindset and wide stops. Because silver is going much higher. The fundamentals guarantee it. But getting there requires surviving the manipulation. And surviving requires understanding how the game is played. This is Asian Guy. It's January 14th, 2026. Silver crashed from $93 to $83 overnight in a coordinated stop hunt. Thousands of retail traders got liquidated. The institution stole their positions. And now silver is back at $91, heading toward $100 like nothing happened. Don't let this happen to you. Use wide stops. Think like a swing trader. Protect yourself. And remember, the banks don't use stop losses because they have unlimited capital. You're retail, so you need stops, but make them wide enough to survive the manipulation. The target is still $150, $200. The timeline is still accelerating. The shortage is still real, but you have to survive to get there. Position accordingly. Be smart, be patient, and don't give your shares to the banks at $85 when the real price is $104 in Shanghai and $132 in India. Stay safe out there, protect your positions, and I'll see you in the next video.